back to understand it. Sometimes when you watch it back several times,
Yeah.
it might give you a better feel and understanding for it. Basically, what we did for Dr. Asim is we gave him what we call a split dollar program. And these programs allow you to take the money that you're making within your practice, if your practice is an S Corp or a C Corp or whatever, and allows you to pay the corporate taxes on money that you can use to build a tax-free retirement plan on. Instead of paying at the top 37% personal income rate, you just pay the 21% business rate on that money, and then you loan it to yourself to put into this plan. So you buy life insurance, you develop cash value that you can take out tax-free, then you pay yourself back the loan, which is really cool.
Yeah.
And that loan that you pay yourself back is tax-free. So I'm going to chart it out for you so you get a better understanding of it. And so let me share my whiteboard here. And
sounds good.
I'm sorry?
I said it sounds good.
Yeah, it's really awesome. I actually have a very similar plan for myself, for me and my wife. and it's like, you can't believe that the IRS will let us do it, but yes. Anyway.
So you're an accounting, or what you are? CPA? What's your?
Yeah, my background. Okay, so you get to know who I am. I started out in the Air Force. I went to the United States Air Force Academy, and then I was an officer in the Air Force for a period of time. And then I got out and became a management consultant for the Air Force. Then after that, I got into life insurance, okay, and became a retirement planning type of person, as well as, and then I got my master's in economics too along the way. So financial things have always been of interest, but I never wanted to get into securities, like selling people mutual funds, stocks, because I was really concerned about retirement. And I don't think that the retirement should be money that you could afford to lose. You know, there's wealth building, which what those guys, securities guys do, they're on the wealth building side. I'm more retirement planning with money that you can't afford to lose. So everything that I do with my insurance license is indexed. You never lose your money. You always get a gain according to the growth in the marketplace. In fact, I'm going to show you that kind of that idea. And you might be familiar with some of these concepts, but I want to just give you an idea of the idea of indexing and all that. So this is really we operate in this yellow, which is the things that you can control to mitigate any risk, right? So down here, your financial security plan, typically life insurance is down here, your wills. These are events that are under your control that you mitigate through insurance and all these things that we're talking about. And then the wealth planning to grow money with money that you can't afford to lose. You hopefully don't want to, but you know, without great risk, you can't have great gain. You do that with these financial planner guys, but we're in this yellow retirement planning, okay? So some of the retirement planning strategies can be encompassed with, you know, after-tax money, savings, CDs, whatever. You've got tax-deferred money, such as annuities and your pension. You have pre-tax money that you can put away, like a traditional IRA. And then you have tax-free money, such as Roth IRA. And then in our category of permanent life insurance, the cash value that you can grow tax-free and get your money tax-free. Our basis of our planning is really it's not just about how much you accumulate, but what does taxes do to your retirement income in the future, okay? So what we've done is we've created this idea with using life insurance as a way to put pieces in place together that do many things that traditional investments won't let you do. And I'm not suggesting that all your money should be in this. This should be part of what you're doing. And, you know, for some of us, it's a large part of what we're doing. But here's the thing with these type of policies, Dr. Ruel, is that not only does it provide you life insurance should you die, but it also provides you other benefits, which we call living benefits. And I'll get to that. I'll show you what those are later, that can take care of mitigating the risk of long-term care, critical illness, chronic illness, and terminal illness, where your life insurance policy is really is a repository of money that, should those issues occur, that you can accelerate some of that death benefit to help you financially with those situations. Okay.
Yeah.
Now here are the traditional things that people use to grow their retirement. Obviously, you have 401ks, you have a traditional IRA, you have Roth IRAs, and then what we have is an index universal life. So in terms of the criteria on the left, safety. So safety in terms of, can you lose money in these investments? Well, depending on what the investment is, you know, you can lose money potentially in 401ks. You can lose money in traditional IRA. Even with a Roth IRA, there's an opportunity to lose money. With an index universal life, there is no opportunity to ever lose your money. So they're very safe. As far as growth, you can have good growth in a 401k, traditional IRA, Roth IRA, but you for sure are going to get growth out of an IUL. Liquidity, which is always a factor. Liquidity, 401ks are not very liquid. Traditional IRAs are not very liquid. Some Roth IRAs do have liquidity aspects to it. Then, of course, the index universal life, you always have access to the cash value growth in your life insurance. Tax-free, 401k, when you pull the money out, it's not tax-free, it's fully taxable, as is traditional IRA. Roth IRAs, you can pull the money out tax-free, as well as IULs. Limits, there are limits of what you can put in a 401k. There are limits in a traditional IRA and Roth, but IULs, you can grow your money and put whatever you want into it. Then living benefits, the only living benefit opportunities are with index universal life.
Yeah.
Okay, so this next slide talks about how money is taxed. And this really goes into really the difference between a tax-deferred vehicle like a 401k, like a traditional IRA, where you don't pay taxes in the money that you put into it. You only pay taxes on the money when you take it out. And so the concept here is, the question is, would you rather be taxed on the seed or on the harvest? So you might think, okay, that's great. I get a tax break when I put my money and defer the taxes to when it grows. Well, the issue with that is all the money, including what you contributed, is taxable at the end when you pull it out. Whereas if you're in a tax-free situation, like the IULs or even Roth, the contribution you put in is paid with after-tax dollars, but it allows you to grow that money in this vehicle where when you take it out, you are not taxed. So you're not taxed on, you might pay it on the seed, but on the harvest, you're not taxed. So it's 100% tax-free. And I'll show you what the cost of that is. So the cost of deferring taxes. Okay, so this really points out in a numerical format the idea that I just mentioned. So let's say you put away $10,000 a year for 30 years. Let's say you're on the 22% tax bracket. So you defer $2,200 a year in taxes. So you don't pay the $2,200. So you save basically $66,000 in taxes. And let's say your savings and whatever investment that is earns you 1.1 million. So you save 66,000. And then when you start taking your money out on retirement income here on the right, let's say you draw out 72,000 a year. Well, you're at the 22% tax bracket, for example, you're going to pay 15, almost 16,000 a year in taxes. So your net income is 56,560. And so let's say you pull that out over the next 25 years, you've paid $398,000 during your retirement in taxes. So the cost of deferring 66,000 to you is 398,000. So when you look at who got the better deal, I think the government got the better deal on that one, right? So that's the cost of deferring taxes. So when it comes to an index vehicle like the one that we're talking about, the Index Universal Life, let's explain how indexing works. So there are three things that your money can do in any kind of vehicle, monetary vehicle, financial vehicle. Your money can grow, your money can stay the same, or your money can go down, it can decrease. The way indexing works is that we mitigate the problem of your money ever going down. Your money will at least earn 0% if the market goes down, but if the market goes up, you'll take advantage of that growth in the market up to a maximum amount. So to mitigate the risk on the bottom side, you're limited on the top side, but at least you still allow your money to grow. So graphically, what this looks like is this chart here. So let's say you put $100,000 in, so the difference between the two lines is the bottom line is the S&P 500. So it really is the average market growth from the last 21 years, this one goes to 2019. So, starting at 2000. And so you can see the S&P 500, the light green line at the bottom. If you put it into the market, immediately at the end of 2000, your 100,000 would be 89,860. And it would continue a downward trend till 2002, where your 100,000 is now worth 59,880. And then you can see that the market gradually increased to 2007. So now your 100,000 is worth 99,931. And then in 2008, we crashed in 2008. So now your 100,000 is worth 61,468. Then there was steady growth up till about 2017. So now your $100,000 is worth 181,945. It dipped down in 2018, it dropped down to 170. Then finally in 2019, it went up. So now your 100,000 is worth 219,859. The top line is if you put your money into an indexed account, where there could be an index fund or an indexed annuity or an index universal life, you put 100,000 in one of these vehicles. Notice that when the market goes down from 2000 to 2002, your 100,000 stays the same. So you never lose any money when the market goes down. Now notice when the market goes up to 2007, your fund grows to 143, 198. And then when it drops down in 2008, it stays the same. So it's still 143, 198. And then again, the steady growth up till 2017, now your 100,000 is worth 293, 391, dips down in 2018, it maintains that amount, and then went up in 2019. So now your $100,000 19 years ago is now worth 325, 664. So this is the power of indexing, where your money grows when the market grows, but it never goes down when the market goes down. Warren Buffett says, for most people, the best thing is to own this kind of index fund. So that's really the idea of the safety of an index universal life, where you got the safety, it's tax-free when you take the money out, it can get good growth, and it's liquid. Now here's the other thing, what's the downside? It's like too good to be true. Well, the catch is, because it's a life insurance policy, you have to qualify medically. So your health has to be at a certain level to be able to qualify for a policy like this. You really need 10 to 20 years to let your cash value grow to the point where the money that it grows to is way more than what you put in. There is a maximum amount, a cap we call it, on how much you can get of the market growth. So, there's a cap on that. And then insurance charges. Because it's a life insurance policy, there are insurance charges on your money, or actually for the life insurance, okay? But here's the thing I say about that all the time, is that when your money is managed by a fund manager or a mutual fund manager, the total fees that they take out of your money by managing your money in one of those type of funds is like 3 to 4%. So every year, just for managing your money, they get their 3 to 4%, whether your money grew or not. So what they're trying to do is try to grow your money beyond their own fee, but it doesn't matter to them as much because they make money whether your money grows. So that's kind of the difference. And our fees for life insurance are way cheaper than the fees that you pay on all your money if you're in one of those type of funds. But here's another feature that I think that really cannot be dismissed, and it's something that I think is really important. And it's the living benefits that you can obtain should you become terminally ill. So for example, if you are diagnosed to die within a period of time, 12 to 24 months, then you have access to your death benefit to use however you wish. And that's a real advantage to these policies. The other aspect of these policies, should you become chronically ill, in other words, unable to perform 2 activities of daily living, which typically is in a long-term care situation, but also can apply whether or not you're in a long-term care facility. Like for example, if you get in a car accident, you cannot perform 2 activities of daily living, you can accelerate part of your death benefit in order to pay for whatever facilities, whatever. So most people think of this as a long-term care scenario, right? But this goes beyond the long-term care scenario. And then the critical illness, if you have a heart attack, stroke, major organ transplant, paralysis, ALS, arterial aneurysms, central nervous system tumors, significant burns, end-stage renal failure, invasive cancer, you can also take advantage of the death benefit in these situations. So Index Universal Life allows you to do all these alongside being able to put away money and draw it out tax-free, okay? Now, in the situation regarding the business side, this is where you can compound the benefits of the things I mentioned, as well as take advantage of the business side of the business, where you can take advantage of the split dollar program. So this is how the split dollar program works, okay? So let's say you have a corporation, your corporate entity over here, and this is you as the individual employee of your corporation. So it could be your spouse's corporation for his policy. It could be your corporation for your policy, whatever the case may be, okay? So the corporate tax rate as of last year is 21%. And the top personal tax rate, I think, is 37.
Yeah, 37, yeah.
Okay. So this is the idea. The idea is that your corporation pays 21% on your money that you make within it, okay? And so what the idea here is, let's say you put, I don't know, let's say 25,000, you loan yourself, you can use any number, I'm just gonna use 25,000 a year as the example. So you loan yourself 25,000, you already pay 21% tax rate on it. You loan yourself 25,000 a year to put into your Index Universal Life as a premium, okay? And so what you're gonna get from the Universal Life is you're gonna get a death benefit. You know, it could be 7 million, it could be 5 million, it could be whatever your age and your health will allow. But it's really a repository for being able to grow your cash value. So you're gonna get a death benefit, you also get all those living benefits. Then the other benefit is the cash value growth, which you can be able to take out tax-free in retirement, okay? So here's how the program works. You loan yourself 25,000, and so what you have to create is a document called a loan agreement, which stipulates that you're going to pay your corporation. So this is where you have to kind of think of yourself as an entity, a corporate entity, and you as an employee, okay? Now you own the corporation, Okay, but you have to think of it this way. Your corporation's lending you this money, so your agreement is that you promise to pay the loan back out of the cash value of the account. Should you pass away anytime here, the death benefit proceeds will go to pay off any outstanding loans, and then the rest of the death benefit goes to your beneficiary. So that's really the essence of the loan agreement. The other aspect of the loan agreement is an interest rate charge. So you can charge yourself an interest rate, okay? So typically in these loan agreements on split dollar programs, you charge yourself 0%, okay? Because you don't want to pay yourself interest. You're going to get an interest-free loan, which is, the IRS says you're going to have an economic benefit as a result of the loan. So what the IRS is going to do is they're going to say that you got an imputed interest benefit. I think the number last year is 0.9%. So basically it's 1%, okay? They're going to say you got an economic benefit of 1% on that loan. So they're going to say, doctor, you're going to have to pay 1% on this loan, right, which is $250. Okay, well, you got the benefit of $250, so you're going to pay taxes at the 30% tax bracket rate on that $250. Okay, does that make sense? So they're going to say you got an imputed value, so you're going to pay 37% on what we think your value is. Now, here's the other kind of cool thing, is that you can deduct, that's a tax deduction on the business side, so you can deduct that $250. It's really cool. So this is year one.
Yeah.
Year two, 25,000. Year three, let's say you put, I don't know, 25 years in it, okay? And I don't know, let's say that's 550,000 that you put into it, okay? So all this time, all this money has been going in to pay the premiums every year. Your cash value grows over time. And then at the end of, say, 25 years, you take, let's say your cash value is, I don't know, let's say it's like 2 million, okay? And your death benefit is, I actually have a real illustration to show you. What you do then is you take out 550,000, you pay yourself the loan. So all this time, in terms of the financials on your books, all this is considered retained earnings. So financially, all these are assets, considered assets to your company. Even though it's loaned out, it's still considered on the plus side of your ledger, all right? And so then when you pay your 550 back, it's tax-free because you didn't earn any money on it. So you can do whatever you want for the 550, but what this 550 did for you is create this huge cash value amount that will give you a lifetime income, tax-free. You have the death benefit and all the living benefits because you're able to loan yourself the money, create this benefit for you, and then give yourself back the money. It's like the greatest thing since sliced bread, in my humble opinion. Okay. So does this sort of make sense so far, Doctor?
Yeah.
Okay.
Yes, yeah.
So let me show you what an illustration looks like in this concept. And we can conform one exactly to what yours would be. So this is someone I did just recently. He's a 38-year-old male, non-tobacco. He wanted to start out with $1 million of insurance. And so we created a program that would give him 6 figures of lifetime income. So this is what that illustration looks like. And this is based on the average S&P 500 over the last like 25 years, which is about a 7.35%. So that's kind of a, just if the past equals the future, this is our best guess of what the future could hold, all right? So 25,000 a year, he has $1 million of life insurance starting out. You can see that he puts 25,000 a year over the next, say, 22 years, all right? And so the cash value growth is this account value here. You can see the cash value growth over time, okay? Now notice at the end of 20 years, he put 500,000 into his policy. look at the cash value that has grown to. It's like 915,000 of cash value, right? And then $1.9 million of life insurance. So, by any stretch of the imagination, when you put away 500,000 to grow 915,000, that's a pretty good return right there. So he's doing it for 22 years. So at age 61, what we do then out of the cash value is we pull 550,000 out in the form of a loan. So it pays himself back to his corporation, but we let the money continue to grow within the policy. So now he decides that at age 66, he decides to take a tax-free retirement of $103,000 every year, tax-free. And so notice by the end of year 30, the benefit that he received by putting $550,000 away, his net benefit is $859,975 in terms of the money that he borrowed out to pay himself back, plus 3 years worth of $103,325. So you can immediately see the economic benefit to include $1.17 million of life insurance that has the critical illness, terminal illness riders in there. So let's continue on.
Yeah.
His money can go for the rest of his life. So you can see here, let's say he lives to age 88. He put in $550,000 into the policy. Now his total real money benefit, $2.9 million. And by the time he's 88, he's got $574,000 in life insurance. So again, when you look at the return on investment over time, it far and away blows away any IRA, any mutual fund. Plus, it has all the life insurance benefits that I mentioned.
And not only that, doctor, actually, I just want to interrupt. Even the 550,000, what you take as a loan, that also comes back to you as a retirement-free income at the retirement.
That's right.
Yeah, correct. So there is no cost involved at all.
Yeah, that's an important concept, that there's no cost to you when you look at it overall. That 550,000 comes back, and that is, you can put that into an annuity. You could do whatever you want with that 550,000. You've already paid the taxes on it. So anyway, I love it.
Yeah.
So that shows you an example of a scenario. And, the younger you are, the more time you have, you can put into it. You can put whatever you want into it. This is just an example